All right, welcome everyone. One more week, one more market wrap with Mr. Pankaj Pandey. This has been an interesting week. Last week हमने काफी सारा फॉल देखा. इस वीक की शुरुआत थोड़ी हल्की हुई, लेकिन बट देन वी सॉ कि ठीक है, थोड़ा संभल गया मार्केट. तो अब यहाँ से क्या आउटलुक बन रहा है हमारा?
Hi, good evening, Vishu. Yes, last week was very volatile. We started this week on a volatile note, but what has happened is that Nifty has recouped most of the intra-week losses, which is why it has closed on a weekly basis flattish. The broader markets have done even more better with a gain of about 1%. And like we have been highlighting this year, Nifty has the tendency to correct 5 to 6% and takes support at say 50-day exponential moving average, and that is what has also happened this time as well. Despite a lot of global fears which we had, I think good part is जो इलेक्शन के रिजल्ट्स थे प्लस जो आरबीआई पॉलिसी थी कहीं ना कहीं वो उसने ओवरऑल दैट सॉर्ट ऑफ शिफ्टेड और that sort of lightened up the mood of the entire market. And as a result of that, Nifty recouped most of the losses and has closed flattish. Our sense is that going forward, since we are starting the result season, so Nifty will be consolidation is what we would expect. It could consolidate in this range of 24,700 to 25,500. And I think good part also is that you are not seeing further rising conflict between Israel and Iran, and also the crude oil prices have appeared to sort of top out. And RBI also sort of helped in terms of changing their stance. So all in all, I think the mood of the market definitely has changed for better this week.
Right, absolutely. Can we explore a bit more on RBI changing its stance? I think the growth forecast has been maintained, but stance has been taken as neutral now. So, what is happening, and what do we expect from RBI from here on?
So RBI policy was largely on expected lines, Vishu, but I think the biggest key takeaway was that this is the first step RBI is taken towards rate cut cycle. Because what they are saying is that they're changing the liquidity stance to neutral from earlier withdrawal of accommodation. And like you said, they have maintained the GDP growth rate at 7.2% for FY25, while for first quarter, they have increased it by 10 bips. So no major changes what they have done. They've maintained the inflation guidance at 4.5%. So no major changes. Good part is that now you have a very divided camp in the market. So one camp favoring that we will see a rate cut in December because Fed has already cut rates by 50 bips and another 25 bips is what they are going to do. And people are saying that if the monsoon has been good, then overall RBI should sort of cut rates. But there is a camp which is also in favor that rate cuts should not be rushed into, and there are some concerns. If you look at RBI has been taking measures in terms of unsecured segment, really not living up to the asset quality expectation. But our overall sense is that market is not really worried about whether a cut will happen in December or in February. The 10-year yields have already corrected by 45 to 50 bips. So market has already factored in a 50 bips kind of a rate cut. And if RBI sort of does the rate cut, our sense is that probably the yield could decline further. In general, we should expect a 75 to 100 bips kind of a rate cut. That is the kind of a headroom which we have. Because see, repo rate is 6.5%, your inflation is 4.5%. So you clearly have 2% real interest rate. Even a 1% real positive rate is sufficient enough. So 75 to 100 bips kind of a rate cut. Again, timing is a different thing to sort of look at. But largely, that is what the expectation should be.
Right, absolutely. And I think the what connection can we establish it to the debt market, because they are, I think, very much dependent on our interest rates, of course.
So debt market, there is also a perspective that the Indian bonds will get included in new indices, and that could also trigger good amount of inflows. But like I said, yields this year have already declined by about 50 bips. So market is or debt market is already factoring 50 bips kind of a rate cut. And like I highlighted, there is a scope for at least or rate cuts to the tune of about 100 bips. Now, timing is something which is challenging because, like I said, one segment of the market expects the rate cut to happen in December. The other one expects to happen in the month of February. So I think, but our sense is that the probability of a rate cut in December is slightly higher compared to February. So from that perspective, we're keeping our fingers crossed for early rate cut.
Absolutely. Let's talk about mutual funds. How have been the inflows recently, and what is the outlook forming there?
So I think overall, see, the inflows continue to remain strong while we compare the data on a month-on-month basis, and obviously you cannot have a linear trend in terms of higher number of inflows. So if you sort of don't dissect that number from that lens, the numbers have been pretty good. So whether you look at excluding NFO or including NFO, the inflows have been pretty robust. So while August was a record at 38,000, for example, overall inflows, this month it's about 34,400. Excluding NFO, it's again 24,500. A good part is that the SIP continues to sort of see a good jump. Now the SIP is crossed 24,509. I mean, you are getting literally $3 billion kind of a monthly inflows, which is massive. And in terms of categories also, mid cap, small cap continue to get those regular 3,000 kind of a monthly inflows. And large caps have seen some bit of a revival in terms of inflows. So they're getting about 1,800 crore kind of inflows. So from that perspective, no structural change or damage you see to the domestic liquidity inflows. In fact, if you look at the kind of FI selling what we have seen in the last 10, 15 days, I think it is the domestic or the mutual funds which have really sort of cushioned the overall impact in the markets. And as a result, we have seen that markets have largely recovered most of the losses.
Right, absolutely. I think as big Indians are getting on SIPs, they are just as big on IPOs. And on that note, we have another biggest IPO, yet again, biggest IPO coming up with Hyundai's IPO. So what is our outlook forming on that?
Absolutely, you're right. We are seeing the biggest IPO in the history of Indian capital markets, which is Hyundai. Prior to that, it was LIC. Now, Hyundai is obviously a well-known company. It's part of the South Korea-based company, and it is the third largest player globally. And domestically, they have got a market share of 15%. And I think most of the brands are quite well known. And if you look at the money, what they are looking to raise is somewhere about 28,000 odd crores, which is massive number. And this number is not going to be used for any, so none of this money is coming to the Indian operations. This is going to the global parent, because global parent is realizing that the value potential in India is fairly high, which is why this company is sort of getting listed. And good part also is that, see, we have already seen the Indian passenger vehicle market tilting more towards SUV. So Hyundai derives 63% of the sales through their SUV portfolio, and whereas the industry derives 60%. So they are stronger in the SUV domain. And overall sense is that when you sort of look at from a number perspective, numbers are more or less similar to what the market leader Maruti delivers. So sales for this company has grown at 20% CAGR. Profit has grown even more higher at 48% CAGR. Margin profile is largely similar to what Maruti also does. So we like this company since it is at a slight discount to Maruti, and which is why we have recommended investors to subscribe to this IPO. Because we feel that it's a better alternative compared to Maruti, because Maruti historically has been lagging in terms of new product launches, or their overall trajectory towards EV migration is also quite slow. I think that way Hyundai definitely scores better, and which is why I feel that it's a subscribe from a long-term perspective.
Absolutely, sir. Sir, another big event that is on the horizon is Q2 results, of course. Can we talk a little bit about what are we expecting from IT as a sector, and specifically how is TCS gonna do?
So TCS numbers have already come out. So I'll come to TCS numbers specifically. So if you look at, this is the only first quarter where you are going to see most of your tier one companies delivering, say, somewhere about 1.5 to 1.8% kind of a quarter-on-quarter dollar revenue growth. Even for tier two, the numbers are expected to be better in terms of good companies like, say, Coforge and LTI Mindtree sort of doing relatively better. And margin profile for most of the companies, we are going to see a 50 to 70 bips kind of a expansion in margins. And I think the only challenge in tier one is Wipro. Wipro is expected to witness a decline. I think this is one company which is yet to sort of deliver meaningful growth compared to peers. And so from that perspective, most of the companies are expected to sort of come out with a decent set of numbers. But those numbers are not really magical to sort of see a fairly large performance, because see, if you sort of notice, these companies or IT companies have already, or IT index itself has delivered about 19% kind of a return in the last 6 months, and 12-13% in the last 3 months. So it's already being captured there for further upside. You need pretty good set of numbers. Now coming to TCS numbers, so TCS numbers were okay, not really great enough to sort of fire up the stock. So if you look at dollar revenue growth was 2.2%, so largely on expected lines. And if you look at, it's been driven by some of the lesser known segments, like, say, for example, manufacturing, which has got a lower mix, or energy resources, utilities. So which again is the mix is in single digits. So the biggest vertical for them is, say, for example, BFSI. Now BFSI, this is the second consecutive quarter. We are seeing about 2% kind of a quarter-on-quarter growth. So there, the things have started to sort of look slightly better, but not really great enough. And the good part is that margins have come at 24%, and company is maintaining a margin band of 26 to 28 odd percent. And they're saying that by end of Q4, the margin profile is going to go up to 26%. And we have also started to see traction in the AI, Gen AI segments or engagements. And overall sense is that this is one segment which can sort of probably lift the mood of the company going forward. But as of now, you really do not have big triggers to fire this stock to sort of do very well. And again, since US is heading into election, we have already discussed the kind of divergent policies which are expected to sort of come up. Till that time, it's very difficult to get a directional movement in IT stocks. And TCS is trading at 26p multiple, so which is at the upper end of the historical valuation. So upside potential, according to us, is limited there.
Let's also talk about sector defense, because I think there's around 80,000 crores of acquisition that has just been announced by the government. So who is this gonna benefit, and is this, again, we have been getting so many news around defense, and then there were concerns around the valuations, and then this news again comes along. So how do we look at this?
So I think in defense, if you look at from a price performance perspective, most of the stocks would have corrected 35 to 40%. And overall, if you look at, there's a perspective setting in that the best is over for defense. But I would just want to sort of highlight is that I think up till now, last 2 years, the Defense Acquisition Council has approved about, I think, closer to under 7 lakh crore kind of a project. And with this announcement of about 80,000 odd crores, this number is even expected to go up. Now, since the stock prices have performed, they can't really sort of keep doing better all the quarters or all the months. So there'll be a period when the correction will happen. And now our sense is that there'll be a period when the consolidation will also happen. But this sector continues to hold pretty good potential from a long-term perspective. And with that in perspective, 2 submarines worth about, I think, 45,000 crore have been ordered. Then another 31 Predator drones are going to be purchased. and are going to be manufactured. So now key beneficiaries again would be Mishra Dhatu Nigam Limited, or Midhani is what we call. So it is a key supplier of materials and other alloys which are used in submarine. You don't get a defense product without electronics. So Bharat Electronics obviously has a role to play, and you would require even the services of Bharat Dynamics Limited, because you would need subsystems, missiles, and torpedoes. And our sense is probably there could be some scope for L&T, but we are yet to sort of figure that out. On the drone side, Bharat Forge is expected to be a key partner, and our sense is that there could be indigenous content to the extent of about 30% initially. But let's see. But defense is something which is a segment which is going to be in the limelight for a good period of time, largely because you have very hostile neighbors, and say for example, a country like China has already deployed 400 fifth generation aircraft, and we'll get our fifth generation aircraft somewhere in 2030 onwards, or early part of 2030. So that way, we have a lot more room to catch up, and defense is going to remain in vogue for a decent period of time.
Absolutely. Another big news this week was SKF India with its board announcing that they'll demerge their automotive and their industrial businesses. How do we look at this development?
So, Vishu, if you look at bearing is a very basic product and is required across sectors, be it auto, be it railways, or a lot of in the industrial segment. And most of these companies operate in both the segments, which is the auto and industrial. Now, coming specific to SKF, it's a company which has got a turnover of 4,570. Now, overall, the way to sort of look at is that say 50% of the revenue is coming from the industrial segment, and then you have auto contributing about 40 odd percent. Now, auto is a fairly sort of a discovered business. Auto is going to see 5 to 7% kind of a growth, or high single digit kind of a growth. And there the margin profile is good. I think the surprise is going to come on the industrial side, because in the industrial side, what happens that the localization is still weak. So localization is still for about 40 to 45%. And as you increase the localization, the overall margin profile will also go up. The overall expectation of a sustained growth in the industrial segment is going to be higher. So if both the businesses get listed somewhere down the line, I think we are going to focus more on the industrial segment, because that is where the scope for margin expansion plus longevity of growth is there. Not to say that auto is going to be bad, but definitely the industrial segment is going to get a better multiple. And overall, I think this is the only segment in the capital goods space which has not done so well, and which is why I feel that if someone wants to take an exposure towards capital goods, I think bearing companies are a good proxy for that.
Awesome. Thank you, sir. Right. Let's now move on to the final segment, which is the hidden gem of the week. Which will it be this week?
So cement is the most hated sector these days. Last 1 year, the prices are down. Nobody's liking cement, as if this is a sector which should not be touched. But our sense is that that is the time when you should be sort of touching that particular sector or stock. Because no point in touching a sector or stock when it is already rallied. Now, coming specifically to JK Lakshmi Cement, here our target price is 960. See, last 2 years, the volume growth was 4-5%. So that did not help. And as a result, the company's growth was muted. But now the company has been expanding capacity. So they have increased their capacity from 14 million tons to 16.5 million tons. So it's a mid-size cement company. And with that, we are expecting a 10% kind of a growth. And they are not going to stop at say 16.5. Eventually, they want to take it to about 24 million ton kind of a capacity by FY27. So you will have a fairly long period or decent period of growth in capacity. And our sense is that in the second half, things are going to be better in terms of pricing. So overall sense is that the pricing will improve, and that should benefit most of the companies, including JK Lakshmi Cement as well. And which is why we feel that the stock is quite attractive valued at less than 10 times EV by EBITDA, or $70 EV per ton. And overall sense is that despite all this capex, their debt to EBITDA is going to be sort of a comfortable. And so they were making a margin of say about 600 rupees per ton, and our sense is that should improve to 900 rupees per ton in the next 1 or 2 years, and that is not a really significantly high margin. So I think cement is down, but it's not out, and which is why one should look at this sector from the next 6 to 12 month perspective.
Awesome. Well, that was a show for the day. Thank you so much, Pankaj sir, for highlighting these events and the happenings of the market. We'll be back next week. In the meantime, if you have any questions, please do put them now in the comments and we'll get back. Hope you like this. Thank you so much for watching. Bye-bye.
Thank you.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.